just us this week. Jay's out. Not sure where Peter is. He's lost in transit. So I suppose the last week or so has probably been a bit better times for the market as well. So maybe a bit easier to jump on here and have a chat about it. So I suppose maybe to kick it off, Hamish, just general thoughts on how things have been tracking over the last week or two. Obviously pretty positive when we look at our portfolios, which is nice, but always, keeping a reality check on things. We're not out of the mess yet.
Yeah, for sure. So, I mean, I think as far as, markets have been strong, probably because the US election is sort of the result that the market wanted, i.e. The volatility of Trump is gone. But in addition to that, it looks like the Republicans potentially hold the Senate, which means that they don't get the tax increases through. So it was sort of the perfect scenario as far as the market's concerned. And I think that's why the market had a kick. And then you combine that with the news around the vaccines. And so, again, everything is sort of lining up for a recovery, into next year. And then you combine that with the huge amount of accommodation that the central banks are flooding markets with liquidity, ultra low interest rates and all of that sort of stuff. So markets look very expensive based on today's earnings, but really what they're trying to do is look out the next year or two and say, if we get an earnings recovery here, then markets start to look more reasonable.
Does it just sort of appear that the COVID impacts in America and the fact they haven't really done anything to get on top of it isn't really having a huge weight on the markets broadly, though? Is that sort of almost just not a factor at the moment?
Yeah, that's right. I mean, I think there's two things. There's the market is a forward-looking thing, so it's trying to anticipate the recovery. That would be one factor. But the other factor is these low interest rates, and again, because interest rates are so low, this quantitative easing stuff, which I think we've spoken about in the past, is supportive of asset prices. So whether that's a property or whether that's a share, these ultra low interest rates is what's sort of elevating markets. And so I think it's a combination of those two factors that's kind of holding markets up.
I suppose maybe jumping sideways a little bit, we were just chatting about this before, but we're just a couple of the offers that we've seen come through, and a few clients have had the question around NAB and Westpac, and I think there's been a CBA one not long ago as well. Just around the hybrids or capital notes or whatever you would like to sort of call them. Just a quick explanation on sort of what they actually are, and then I suppose we haven't used them broadly for clients, so probably just the reasoning behind that as well.
Yeah, for sure. I think one of the things which we've discussed is that there may be challenges around the AMP framework there, so I'm not sure whether clients are able to hold these things or not. But just to explain what they are, they're called a hybrid because they're not traditional fixed income and they're not shares. So they're sort of a form of fixed income, but they're basically the riskiest form of fixed income. And the simplest way to think about that is you can have money in a term deposit, which is government guaranteed under $250,000, and rates there or whatever, 0.5% or something. You can go and buy a government bond, so lending money to a government, and rates there might be sort of 0.6%, 0.8%, depending on how long you lend that money for. You can then go and lend money to somebody like a bank, buying senior or subordinated debt, and returns on that might be, call it 2 to 2.5% in this sort of environment. The next level of risk up from that is these hybrid securities, and indicative returns of those are, getting closer around the 4% sort of mark, sort of high threes, low fours, depending on which ones. And then the next level up from that is buying the ordinary shares. So, say a return in the high threes, 4%, clearly that's better than a deposit in terms of return, but that comes with additional risk. And in particular, hybrids can be volatile. So, during the GFC and during the pandemic in March, it's not unusual to see these hybrids fall 20% during that period, and so an investor needs to be conscious of that volatility. Obviously, they can't just assume that if they're buying this thing at $100 that they'll be able to sell it at $100 at any point in time, because it could fall. So they need to be able to hold for the long term and manage that volatility. That's one factor. The other important thing is the correlation that they have with the ordinary bank shares. And so where it becomes, hybrids have a place for some portfolios, particularly people that need income, but where they become dangerous is if you have too much exposure to bank hybrids in a portfolio. And in addition to that, if you also have a lot of exposure to ordinary bank shares, and then you are doubling up on your risks are very concentrated in that sector.
Thanks for that. I suppose just linking back to your point around asset allocation and the framework we're allowed to use them, is where it gets difficult is that because of that volatility in the actual value of it, they get deemed to be a growth asset. So essentially we'd have to give up our direct share exposures and pure growth assets to hold something that's sort of sitting on the fence a little bit between the two. So we've been more traditional in having the direct assets and the actual pure growth assets, and then our really super defensive capital stable assets as well. So the hybrids, as the name would suggest, sort of sit in the middle, but from an asset allocation point of view and overall risk tolerance level, they don't really work overly well with most portfolios. There is still a place for them for some people. So that's where they fall in that sort of middle ground, which from a compliance side of things doesn't always work so well.
Yeah, that's really interesting, and it makes it. I mean, in reality, equities are going to give you better returns than hybrids over the long term, but they will be more volatile again than hybrids, and so you've sort of got to weigh that up on a client by client basis.
It's just determining if there is a opportunity for any of those hybrids to sort of top up that defensive portion with that higher risk, isn't there, and say, well, interest rates are at their lowest point. Is there any need to look at the hybrid as another option to create some income? So thanks for your insights, Hamish.
A million different options out there, which is always keeps us on our toes. I suppose it's probably a little bit, we haven't got a whole heap of stuff to go through, I suppose, which is probably a good thing when the market's sort of going along and there's not heaps happening. It's probably a good thing, but I suppose keep it pretty brief today, unless you had anything else you wanted to put in there about any specific stocks or anything.
No, the only other thing I'd mention maybe is just I'm not sure whether you have seen, but Future Generation, Louise Walsh, the CEO, is starting to do these podcasts.
Yeah.
And she's getting some really good guests on there. So I listened to one yesterday for the person that runs Caledonia, so Future Generation invests in the Caledonia fund, and that has just been an incredible fund. The thing that blew me away from that podcast, I didn't actually even realise this, but this guy is actually friends with Charlie Munger, who's Warren Buffett's right-hand man. So he actually has a Zoom call with Charlie Munger every Tuesday, which just blows my mind. And remember, as a shareholder in Future Generation, you get to invest in Caledonia for free. And normally, for sort of ultra high net worth investors that invest in Caledonia directly, I think their fee structure is something like a base fee of 2% and then a performance fee of 20% of any positive performance. So, and their performance has been amazing. So, clients are probably paying 5-6% in terms of fees. Future Generation gets to invest in it for free. But I would just encourage people to probably take the time to listen to some of those podcasts, because it just highlights the quality of the underlying managers in there.
You might be able to post a link for those.
Yeah, I think Jay and I've had a listen or a look at a couple of them. They look good. Got some good guests. They obviously have some good connections, which helps.
Mm-hmm.
Not to say you're not a good guest on our
no. much more interesting than me. I'll tell you that. That's for sure.
Beautiful. All right, thanks for that, mate. And we'll chat again next fortnight, I suppose.
Sounds good.